Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today. If you haven't already, I suggest that you watch my inflation video. It's June 9th. It's a Thursday, June 9th, 2022. And I also released an inflation video today just talking about the expectations for what the CPI print is going to be. That's the Consumer Price Index for tomorrow. That's Friday, June 10th. And that one is just a little bit more important in terms of the subject matter. So I highly recommend that you go and watch that instead of this one. Though I would like you to watch this one as well, because we're going to talk about some interesting stuff. I think that other one is just going to be a little bit more consequential, and I do hope you'll enjoy it. Okay, today I'm going to be talking about household net worth, a statistic that was released today on the first quarter of 2021. And if you're not in the business of financial reporting, that would be the quarter from January ending in March 31st, ending on March 31st. So the first 3 months of the year. All right. So, and then I'm also going to talk about jobless claims, because we got our 9th consecutive week of increase in the 4-week moving average of jobless claims, which is a pretty solid indicator for upcoming weakness in the labor market, which essentially means very, very unfortunately, this is one of the worst things about economic downturns. People, like I said, very unfortunately losing jobs. So in order to do all that, I'm going to get out of the way. And the first thing that we're going to look at is the change in household net worth over the 2.5 years, or really the 2 years starting at the end of 2019 and ending Q4 2021. That would be the quarter ending December 31st, 2021, right? So what I wanted to, and I just think that this is kind of fascinating. So these are the changes in net worth, or the changes in the different types of assets held by households across the United States. And this is, again, 2019 to Q4 2021. And we start with, these are percentage increases, so we're going to look at just dollar amounts here in the next slide. But we start with checkable deposits and currency. That's basically another way of saying checking accounts, and paper dollars in people's wallets or, safes or whatever. And that went up quite a bit on a percentage basis. We're talking 250%. And the thing to trace that to really is all of the stimulus packages, basically the broad-based welfare checks that were released to the public with the various 3 COVID stimulus acts, or COVID care acts, or COVID caretaking acts, or whatever you want to call them. All right, so next down on the list, it looks really small, but it's actually really not. Corporate equities, so the assets attributable to the household's holding of corporate equities, which is another way of saying stocks, right? Corporate equities increased by about 54%. Then down the list, we have money market funds. Then down the list, we have durable goods. You can lump in the used cars that people own, or the used and new cars that people own, into that category. Owner-occupied real estate, which just means people who own their houses outright. So the value of those homes, they don't owe any more money to the bank or the investor on the side of the mortgage bond. They own their house outright. That's what owner-occupied real estate means. Proprietors' equity in business, that's the estimated value of businesses that is owned by non-corporations. And then we had real estate, just this designated real estate here means there's somebody mowing their lawn. I apologize for that. This type of real estate is the type that people actually do owe money on, like me. I owe, hundreds of thousands of dollars on the house that I live in. So is it really mine? I don't know. All right, but what's also really interesting, so we had stocks go up 54%, money market funds 29.7%, real estate 27%. A lot of this is increase in valuation. So that's an important thing to keep in mind when we look at these increases, and I'll point this out when we look at the dollar increases in a little bit. When we look at these increases, we're not talking about the amount of money necessarily that flowed into these different types of assets, except for checkable deposits and currencies, because $1 is always worth $1, at least from an accounting standpoint. So this is the one instance where that would be a direct dollar inflow into checkable deposits and currencies. But everything else, you're talking about a valuation of assets. So if stock prices appreciate, their average prices go up, and if home prices appreciate, appreciate, they go up a lot, which we know that they did quite substantially, then this increase in net worth tends to happen. What went down quite a bit is holdings of U.S. Treasury securities. Now, that's another way of saying U.S. bonds, U.S. government bonds, and then agency mortgage-backed securities. So those are the mortgage securities that are sold by Freddie Mac, Ginnie Mae, and Fannie Mae to basically finance the borrowing of money for houses for most of the loans, about 80 to 85% of all mortgage loans that are made in the United States. People sold the hell out of those in 2020 and 2021, and they sold the hell out of their treasury bonds. Didn't want them. So it's interesting because while the Federal Reserve Bank was buying quite a bit of U.S. Treasury securities and buying quite a bit of agency mortgage-backed securities, everybody else was sort of letting them go, at least as far as households go. They were not a preferred savings or investment vehicle. Now let's look at the same thing, and this is another ordered list, but this is in dollars, and I really hope that that damn lawnmower does not end up too loud in the background in this video, because I'm not doing it over again. But it really pisses me off that people mow their lawn at 6:18 in the evening, especially because, well, there's no chance my neighbors are watching this. This person across the street doesn't even work. I mean, they're like way past working age. So, okay, I think they stopped. Anyway, am I going to get rid of that rant, or am I going to leave it in? I think I'm going to leave it in. Yeah, I'm, whatever. So, changes in net worth from 2019 to Q4 2021 in dollars. Corporate equities. So, again, a huge increase in the value of stocks. That would be an 11 trillion increase in stock valuation on the balance sheets of a household. And you have to remember that this is some portion dollar inflows, so people putting more dollars into the stock market than they did before. And it's also some portion just appreciation in those assets. So the prices of those assets going up. No doubt people plunged a lot of their stimulus money into the stock market because a lot of people didn't need it. And no doubt there was just a lot of price appreciation in those assets. How much of each thing is not exactly known, but there is some flow of funds data that is available that I will probably try to share on this platform here in the not too distant future. Real estate went up by 8.87 trillion. The owner occupied real estate went up by 8.1 trillion. So again, the difference between these two is this real estate category includes people who is made up of people who owe money on their house, so they have their house is attached to a debt instrument, a debt obligation, and then owned outright real estate is real estate, houses, and other types of properties that people don't owe any money on, which is really the best kind, if we're being honest. We have 8.1 trillion there in real estate that's owned outright. Pension entitlements were actually, if you notice, there's a pretty big jump from stocks and then to real estate and then down to pension entitlements. So you have a difference of 3 trillion and then another jump down of 5 trillion down to pension entitlements. And then there's evidence that people actually sold a lot of treasury securities over this time. So we had a negative outflow, at least in the value of these assets, of just under $1 trillion. So 0.88 trillion, or another way of saying that would be $889 billion in treasury securities that people got rid of. And some portion of that is the valuation, but since the value of treasury securities actually goes up, and again, when we talk about treasury securities, we mean U.S. government bonds, right? So since the value of these treasuries actually goes up when interest rates go down, and we have been in a very low interest rate environment over the last couple of years, at least until January 2022, this is actually most likely made up of actual outflows. So people selling their treasury bonds and electing to do other things with their money, such as go into money market mutual funds and go into stocks. So a lot of money and a lot of stimulus money went into stocks over the last couple of years. So why do people dump bonds? I mentioned this briefly, but basically because the rates of return on them were so freaking stinking low. So both the yields on which is just another way of saying rate of return, but both the yields on U.S. 2-year Treasury securities went way down to basically a record low during the COVID pandemic, and the same thing happened with the 10-year Treasury. All right, and then the same thing happened with mortgage-backed securities, even though I don't show that on this chart. The yields on mortgage-backed securities, again, yield is just another way of expressing rate of return or the amount of interest that those types of securities will pay. The yield on mortgage-backed securities is closely tied to the yield on U.S. 10-year Treasury bonds, and so those went down considerably too. People dumped those and got into riskier assets such as corporate stocks and things like that. And they also dumped their corporate equities. So I believe, corporate and foreign bonds also went down a little bit over that 2-year period as well. So stocks did the opposite, and that's why everybody wanted to get themselves a piece of the stock market. So they bottomed here basically in the second week of March 2020. I think I got back into the stock market on March 14th, and then everything went up, just way up, basically went parabolic. And then what happened after that? Well, as played into the current decrease in net worth, or the recent decrease in net worth, the stock market has basically been giving back a lot of those gains ever since the beginning of this year. So since January of this year, there's been a pretty steady downtrend in the stock market. This is not a crash, okay? So if a stock market corrects, 10, 15, 20% over a course of 6 months, you can't call that a crash. A crash is like, 10% a week for 4 weeks straight, like what happened back here leading up to the COVID-19 pandemic and all that stuff. So, the stock market has been giving up a lot of these gains, and that's why we saw this small decrease, and I will say it's a pretty small decrease in household net worth. So, some details from the report that was released today. The value of corporate equities held by households, including indirectly, declined by $2.96 trillion. Household net worth has hovered in recent years around $150 trillion, maybe it's 140. Somewhere in there. So, 2.96 is not a ton. But anyway, so 2.96 trillion in one quarter, it's quite a lot, because if you think of household net worth, a lot of that is accrued over decades and decades of working and saving, right? So the S&P 500 index fell about 5% in the first quarter as the Fed launched its plan to tighten financial conditions to bring inflation down. This was partly offset by continued gains in the value of real estate. Home prices have still been going up, at least up till recently. On the liabilities side, household debt, this is what is a little bit more concerning. Household debt grew 8.3%, so actually more than the S&P 500 dropped, or more than stocks dropped in the first quarter, to 18.3 trillion after an 8% rise in the fourth quarter of 2021. That would be the one ending December 31st. Mortgage debt rose 8% because people are still taking out loans to buy houses. Non-mortgage, or were, in the first quarter. Non-mortgage credit card debt rose. That's really the concerning one because it doesn't have collateral backing it. Non-mortgage credit card debt rose 8.7% to 4.5 trillion, buoyed in part by auto loans. I think that might be a typo on their part because credit card debt does not include auto loans. So maybe it's just non-mortgage consumer credit is probably what they mean. So the auto loans, the value of the auto loans on the books of financial institutions and on the obligation side of the balance sheet of households is definitely going up because they're so much more expensive. And that is also not a great thing because if there's a slowdown in the automobile market or there's more availability, then eventually a lot of those loans end up being underwater, which is fine if you do not want to sell the car. But a lot of people like to rotate out of the cars that they have every, 1, 2, 3 years. A lot of people don't stay in them until they pay them off. So definitely reduces their optionality to do that. So now I just want to get into jobless claims. So I hope you found that information on household net worth interesting. It's been, a huge driver behind it. It confirms the idea that a huge driver behind these increases in stock valuations has just been how much of a pivot there's been from these, from these bond type instruments when it comes to how people want to save and invest their money. There seemed to have been a pretty significant pivot from going into U.S. Treasury securities, U.S. government bonds and mortgage-backed securities, the safe stuff, and pivoting into the higher risk sorts of assets like the S&P 500 and these different stock indexes that you can invest in, and that's all fine and good. And I definitely did a very similar thing. I don't touch bonds with a 10-foot pole unless they're inflation adjusted. Or unless they're about to go back up in value because the Fed's going to cut rates. So I do personally have a holding in bonds right now, and this is not financial advice, by the way, but it's not exactly a bad thing. But one thing that it does do, now that the average investment portfolio does have a larger stake in stocks, is that it makes people's net worth more susceptible to drops in the stock market, which tends to be a little bit more volatile than real estate, right? So now I want to get into jobless claims and just point out with this quick chart. So this goes all the way back to 2017, and in comparison to what happened in the COVID-19 pandemic, this is why outliers are kind of a pain in the ass. But in comparison to what happened, you can't really tell a whole lot of change here. There's definitely a lot more interesting stuff under the hood, when you take out this outlier. But you can kind of tell, if you look closely at this chart, that we have this upturn, and that looks really, really tiny and insignificant. But again, these, as we keep piling on weeks of consecutive increases in this 4-week moving average of initial jobless claims, we get closer and closer to unprecedented and rare amounts of weakness in the job market. So the only times that you really see these types of consecutive weeks where jobless claims are continually rising, they tend to be times leading up to when the unemployment rate spikes, or when around times when credit markets are broken, and eventually what I basically mean are times that lead up to economic recessions, which are times that economists and policymakers, at least presumably, even though they are always tend to be causing them, want to be avoiding as much as possible. So times when the human standard of living in the country drops and there are fewer jobs available and fewer goods and services available. So we, again, just wanted to log, we had a 9th consecutive week. Technically, last week was an unchanged, right? So the week before was 207,000, and then the 4-week average after that was another 207,000. So with that, you kind of have to gauge it on what happens the week after. So if the jobless claims had gone down, then I would say that the consecutive increasing jobless claims ended 2 weeks ago. But since they went back up, or since they continued to go up on that trend, then my interpretation, or what I would call it, is that it would be the 9th consecutive rise, okay? Because they're still basically on this uptrend and didn't have any breaks. So that's how I think about it, and it's certainly, anybody could definitely have their own reasoning and disagree, but I report on this every week, so if there are any major developments, you will be the first to know. All right, so I hope you'll join me for Supply and Demand Daily tomorrow. That's Friday, June 10th, 2022. I don't actually remember off the top of my head what I'm going to talk about, but I'm sure it's going to be awesome. So stay tuned and be there, and I'll talk to you later. Thank you very much for joining, and have a happy Thursday evening. Goodbye.